Before getting into exactly how to use multiple time frame analysis, let's talk about why it's so important to look at more than just one time frame. Here we are looking at a 15-minute chart of Euro USD. We have a 200 EMA or exponential moving average on this chart, and you can see in this downtrend it's holding really well as resistance with the market bouncing off of it several times. We are currently at this point in the market, and it looks like it's going to bounce off again of that 200 EMA. It seems like a great time to sell, right? But let's look at what happened next. Price shot up and broke right through that resistance. And then after that, it rose another 100 pips. So what the heck happened? Let's look at this exact same point in the market, but at the 4-hour chart to get a bigger picture. Look at that. You can see right here on the 4-hour chart, which is exactly in the same place we just were, but on the 15-minute chart, that this looks like a terrible time to sell. And it actually looks like a great time to buy since it's on this major support line. Do you see how important it is to look at multiple time frames? This will probably keep you out of losing trades more than anything else. It will help you see the big picture and decide whether or not the entry is actually a good one. Beginners look at just one time frame and ignore all others, and this is a huge mistake that you're going to be able to avoid from the get-go. So now that we know that it's important, how do we use multiple time frame analysis to find better entry and exit points? First of all, take a broad look at what's happening by looking at the larger time frames. A trend in a larger time frame has taken more time to develop, so it will need a bigger market move to change direction. Support and resistance is also much stronger at these larger time frames. So start with your preferred time frame. For example, here we're on AUD USD on the 1-hour chart. And then from there, go to the next highest time frame. So go to the 4-hour chart in this example. You can check the larger time frame whether the market is trending or ranging, and then move back to your time frame or even a lower time frame and make decisions on where to enter and exit trades. So not only does multiple time frame analysis help us see the big picture, but it can also help us zoom in and find even better, more precise entry and exit points. This is going to really help you have an edge in the market over people who look at just one time frame. So let's go through this example together to make this really clear on how to perform multiple time frame analysis. So like I said, we started here on the 1-hour chart, we moved up to the 4-hour chart here, and this is what's going to give us the big picture and help us determine the overall trend. You can see on the 4-hour chart that it's in an obvious downtrend, and we drew the trend line. But we also threw on here the stochastic indicator, and you can see that right now it's showing that the market is overbought. So the market's overbought, you can see it's about to bounce off of this trend line, and this seems like a great time to sell. So now you move back down to your 1-hour most comfortable time frame, and you also put on the stochastic indicator, and you see that also on the 1-hour time frame, it's showing that the market is overbought. You can see it's also in a downtrend, and it looks like it might bounce off of that resistance line. So your last step is to go down to an even smaller time frame and find a really good entry point. You go down to the 30-minute chart and you check the stochastic indicator, and it's also showing overbought on the 30-minute chart. That's 3 confirmations that the market is overbought, all on different time frames, and probably a good time to sell. That combined with the market bouncing off of the resistance trend lines on the 1-hour and the 4-hour chart give you confidence and you enter into sell trade. Let's see what happened back on the 1-hour chart. Boom! You could have captured 380 pips all the way down to the bottom of the trend from there. Now you may be thinking that the best idea is just to look at every single time frame. And if you do, you're going to go crazy. So just use at least 2 time frames and not more than 3, and that way you don't get really confused. And honestly, there really isn't a wrong way to do multiple time frame analysis, so just find out what works best for you.
Hey, thanks so much for watching. Make sure you join our free Discord channel to get access to all the cheat sheets and a bunch of other cool bonuses. The next video in the course is right here.